What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
Today I'm joined with Terra, and is it pronounced Padgett? Is that your
Padgett? Mm-hmm. Yeah,
Excellent.
unless I want to be French, I can say Padgett, but no,
Padgett, yeah. Well, and how are you doing today, Terra?
I'm doing well, thank you.
Fantastic. And I got some great news for you. I don't know if you're aware of this because this whole podcast episode was, jumped on you a little bit here. But today, I don't know if you're aware of this, but we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, why are you doing that? And the answer is, if you've ever heard of private off-market deals, these are the deals that you're not allowed to publicly discuss, well, you should know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants. And they might take away your business in the form of rescission. That's bad. So I have people on here and we talk about what are your core competencies, what's your buy box, and the benefit to you is you'll not only learn how to more effectively communicate on the subject of commercial real estate deals in their teams, but you're going to also understand how my guest fits into those. But before we get too excited about real estate, Terra, do you want to introduce yourself a little bit?
Yeah, I am Terra Padgett. I am the founder of PowerPool Fund. We're a real estate investment club. And so I have a background in commercial property and casualty insurance. My niche is in real estate. My expertise is working with developers, property management firms, owners, all the gamut that insuring from a property casualty perspective, their portfolios. And so I have enjoy insurance, but I have a passion for real estate entrepreneurship, and that's where my journey into real estate began with single family rentals, and now into the commercial side of the industry with investing as a limited partner in deals. So I have a passion for passive. So I like earning passive income and doing things passively. And I like to say I earn my money. And when I earn my money, that's me hiring George Washington and Benjamin Franklin and Abe Lincoln. And now that they're employees of mine, I got to put them to work. And I don't give PTO. I don't give vacation days. I don't give sick days. I'm a shrewd boss. And so I like to put them to work into the deals that I invest in.
I love it. I love it. And so that brings me to the first segment of the interview. It's the 5 distinct motivations. But before we do that, I got to say, but wait, check your rate. Now, Terra, I don't know if you're able to do this or not, what your technical acumen is, but if you could try to look through the camera and down there in the user's device, there might be this big subscribe button that they should probably do something. Okay, it's a stupid joke, but I've done it in every episode, so I'm keeping on doing it. The 5 distinct motivations. I've now literally interviewed hundreds of different commercial real estate players, and everybody has their own unique reason why they are involved in these different real estate deals. And the reason why we need to know what people's motivations are in real estate is because sometimes the going gets tough and throwing in the towel is pretty tempting. So if you know the motivations, then you got a pretty good idea of what's going to keep them from throwing in the towel in that sort of situation. The first thing to say though on the subject though is that everybody, even though they have their own unique reason, I find they fit pretty well into these 5 distinct motivations. And then that's how we can basically take it to the bank. The first motivation for some people's acquisitions is that they are looking to preserve their purchasing power. Terra already went into some detail about herself, and I think that this has a lot to do with it. But just to explain what it means, some people, they either have more income than they're realistically going to be able to use on lifestyle, and so they need to be getting the best benefit from their investment dollars, making sure that that value doesn't dwindle. Other people people are completely work optional because they've got a portfolio of assets that's paying all their bills. And if you're in that situation, you might ask, well, why would you bother making another acquisition and going through the hassle of, it taking months to close and then years to go full cycle? And there are a couple circumstances. One is if inflation is eating away from the purchasing power of your revenue, your income from your portfolio, it's going to be time to make a new acquisition. But the important thing that is distinct about people who have this as their motivation is they're not going to be making a deal every 10 seconds. They don't have to do deals just for deal's sake, and they're only going to pull the trigger if they're getting a steep discount. Now, of course, everybody should try and negotiate the biggest discount they possibly can, but the emphasis is that these guys don't have to just take any deal that crosses their table. And truth be told, this is not where I am in my real estate journey. What describes me better is trading time directly for wealth. I've got a background in technology, which of course is high salary, high wage, high earner, that sort of thing. And as I kept on pursuing those bigger salaries, I noticed that a tax bill came along that was bigger and bigger and bigger. Eventually you get to the point where they're taking half. And I started working for a real estate firm with my tech skills back in 2014, and my boss at the time, he was doing 10 single family home transactions per month. So I was able to see behind the scenes of like, wow, I seem to be on the wrong side of the right business. And so it hit me that I should probably be pivoting. Instead of pursuing that bigger salary, I should try and get deployed capital as my compensation, in other words, equity. So that's what I'm up to. I get that that's a little bit nuanced for some people, especially youngsters. Youngsters, they tend to want to hustle like crazy so that they can retire early. Other people, which is still the same motivation, they just want to take control of their schedule. Now, that's a fantastic thing. It's great, especially so you can spend more time with your family and things like that. But at the main flaw I find people who are generally motivated by fast tracking the retirement tend to fall into is they think that everybody is secretly trying to retire. And I assure you that is simply not the case. There are some people in this space that absolutely will keep on hustling into their 90s. For example, they're the people who are fueled by ambition, that generational wealth. They want to make sure that their great-grandchildren never have to hold a day job. And that's why they're going to be hustling endlessly. And that's fantastic, even though I know that in some circles that attitude's a little bit vilified. But the fact is somebody has to stay, awake, not fall asleep at the wheel. These properties need to be maintained. Somebody has to be motivated to take care of them. So that level of ambition is actually a great contribution to the GP team. Now, of course, the other type of person who's likely to keep on hustling into their 90s, rather than focusing on their own generational wealth, maybe they focus on a different sector of society or animals or the environment. Who knows what it is? But at least they've figured out that if you want to make a really big impact, there's a financial component to it. So that's why they started doing these commercial real estate acquisitions. So Terra, as far as these 5 different motivations, I know you gave a little bit of insight already, but what combination of these 5 would you say describes you best?
So mine is freedom of choices, freedom of options. I think, money is not the end result. Money is the tool to be able to provide those freedoms. When you have financial freedoms, I don't know if this is a PG-13 or it could be a rated R podcast, but you can bleep it out. But, fuck you money, basically.
Mm-hmm.
So, to where it's not about, oh, I need $10 billion or whatever it may be. So I don't really know what that number is, but it is that to be able to be financially comfortable to where I can take off for a year because I just want to, because I can, and because I have options, or I want to go through the jungles of Tanzania and feed the children. And if that's my choice, or if I want to, sit by the pool and drink margaritas and stay drunk all day long just because I can. That's my choice. So I say a lot of that jokingly and facetiously to say, but a lot of it is freedom of choice. Yes, it's for children. And I think it's a combination of all of those things, for your children, for, your family and life. But I think all of that for me comes into the foundation of it is the freedom of choice. If you want to go, my son wants to be a lawn guy when he grows up. He's 6 years old. I fully support if he wants to be a lawn guy. I just hope that he has the freedom of choice. If it's lawn guy is what he wants to do, be a lawn guy. If it's tech, go be in tech. If it's, having his own cooking show on YouTube, go get your cooking show on YouTube. Why? Because finance is where your next meal, no pun intended, is going to come from, is not a concern. And so I think a lot of what I do in the real estate space and kind of building, the wealth, one deal at a time, $1 at a time, is all for the freedom of choice, to be able to choose where I spend my time, where I put my effort, my energy, anything. It's just really having those options.
I love that answer. And it's always nice starting off with motivations because you get to tap into something really special about individuals. But one of the problems is sometimes when people come on here and talk about their motivations, they seem all starry-eyed, even to the point of naivete, which is a bit of a problem because real estate is a business just like any other business, and there are risks involved in anything. Now, if you've ever been involved in an off-market private deal, the type you're not allowed to discuss, sometimes they're called 506B deals, then you should have had to fill out a suitability questionnaire. If there's a securities attorney in the mix, which there really should be, they should insist that there's documentation, and the financial questionnaire is usually how they do that. Now, when I was going through my first one of these suitability questionnaires and going through the highly invasive questions, what's your net worth, what's your income look like, what sort of investments and assets do you have, when I got to the tolerance for risk assessment question, I felt that all of the multiple choice responses lacked utility. I couldn't really trust the response to be sure that I understood that investor and what their tolerance for risk was. So for this interview, I ended up making my own one, which is a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So Terra, it can be inside real estate, it could be outside real estate. You can give one of each if you want. What's too risky for you to invest in?
No, that's funny. So as I mentioned, I'm a commercial insurance broker by trade. So I am always in my mindset of risk tolerance, and understanding the risk. And it's not about just avoiding all risk possible, but it's understanding the risk and moving forward, knowing what the risks are. And so one of the things, if I'm filling in the blank, there are many popular investment asset classes, but I think private money lending is too risky. So that's my answer. I'm sticking to it. And I know a lot in this space, we depend on private money because, hard money and other forms of money, whether it's conventional loans or whatever, it can either be expensive, too much to have to show and prove. You need to have so many years and background experience. So there are a lot of hurdles when dealing with institutional money. But I do think, that the institutions, they have the resources to kind of, verify and vet and, understand everything that's going on with the deal to deploy money. And even then, I'm sure good old JP Morgan at one point in your time when he was first starting to lend had some defaults, despite all the things that he tried to do to fix them and cover them up right. So I just think that from person to person and peer to peer lending, I do find that to be a risky asset class. And I say that in the same breath. A lot of people listen to this is like, no, because they need it, we depend on it. And that's, how we're able to get deals done. And yes, two things can also be true at the same time, but it is still a very risky when you're dealing with individuals and really trying to truly understand their background and what they're doing with the funds and how they're going to be able to execute to be able to pay you back plus your interest. I find that to be a risky asset class, one that I've done for sure, both on the borrowing side and the lending side. So that's why I can speak pretty confidently around my comments here.
Yeah, that makes lots of sense. You absolutely have to know what your legal recourse looks like. And I have friends who are hard money lenders, and they're embroiled in a few different cases to recover their capital. So it's not pretty, even if you are very familiar with that. So it's a grown up sport for sure. But
good way of putting it. It is
right,
a grown up
exactly.
sport.
Exactly.
No kids in the grown-up pool.
Absolutely. And now for this next question here, I confess that it was not part of the first couple hundred chance encounters, and the reason is because I thought it was a little bit too fastball for the people involved in real estate who are more on a marketing or public relations, basically front of house. They're not the type of person who's going to deep dive into a spreadsheet and a rent roll, the different expense reports and all that sort of thing, and really be at home and understand understand everything that's in there. But I found that even if you are the front of house person, the marketing person, there are going to be some, you're still a curator of deals. You have to be able to choose, hey, this deal looks more promising than that one. And so there's going to be some metrics that they rely on more than others. And so I like to get like a top 3 or something like that. And for anybody in the audience who's only listening and not watching, I always read out these 14 different metrics to jog people's memories. It's not an exhaustive list, but here we go. The first one's cash on cash. Second one is IRR, which is internal rate of return. It's also known as like an equity multiple to get an idea of how many times your money you're going to get after this investment as their projection. Next, you have cost per door. You have net operating income. You have the going in cap rate, because cap rates are generally publicized by different brokerages as far as what's standard in any major city. So it's a back of the envelope way to find out really quickly what kind of discount you're actually getting. Next one is the loan interest rate. It's especially important these days if you're going to be assuming a loan with like seller financing or something like that. Then there's the occupancy rate. I should mention that that is the inverse of the vacancy rate, so it's the same number, just inverted. Then there's the average income where the property is located. The amortization period of the loan. Again, if you're going to be assuming a loan, that's also going to be highly relevant. Next up, you have the difference between the market rents and the in-place rents. That gives you some sort of idea of how much additional revenue you can get from the property. Next, you have the population growth, which is basically baked in demand, which should have an upward force on the rent pricing. Then you have the sponsorship record, which is how many deals have already gone full cycle, how many deals are on the go right now. Then there's the waterfall split and exit strategy, the different words for that. That basically means what happens to your investment after your principal's been returned. Are they waiting till they sell? What's the overall plan here? And then the last one is DSCR, which is debt service coverage ratio, which tells you how much of the revenue from rents and amenities is going out the door immediately just to pay for the loan. Now, once again, it's not an exhaustive list, but Terra, you want to give like a top 3 or something, what you tend to rely on most?
Yeah, I mean, looking at this list, all of the above go into my, analysis of a deal. One thing I'd say, I'll kind of put it in phases. So just first, if it's in the inbox or someone's talking about it, a quick metric for me, not, again, depend on all of them, but a quick metric is the equity multiple. Like, see, okay, if I invest $100,000 over the course of, 3 years, 5 years, whatever they're saying the exit is, my money's going to grow to what rate? So 100,000 at a 1.5 equity multiple. Okay, I can expect $150,000 back on this. 2.0, I can double my money or whatnot. So that's just a quick metric for me to understand how the growth of my money, how it's going to grow projected in that deal. Another thing that I do look at, and I think especially doing what I do within the investment club, I think a lot of people, because real estate is a long game, they like to see a little bit of what I call snacks, throughout the way. So we're going to eat, really, we're going to have a feast at the end when we exit and we sell, and we took a property worth $100,000 and now it's selling for $800,000. That's when we're going to feast, but that's going to be 5 years down the line or whatever. But the cash on cash, I think, is good for a lot of folks, because at least it's the snacks. It's to keep us fed. It's the deals alive. The deals moving. We're executing the business plan, whatever. Of course, new development versus value add difference or whatnot. But I think that if this is one that can provide some type of distributions throughout the term, cash on cash is a good one, because I think it just keeps you be like, okay, yeah, we're still alive. The heart's still beating. We're still breathing until we're ready to really have a feast and really celebrate once we get that big exit. 5 years down the line. So that's another one. For sure, one that I don't see, and maybe it's average income, but not really, but the AAR. Like I said, I know you mentioned this is an exhaustive list, but that's another good, just high level metric to look at, the AAR being the average annual return. So from start to finish, day one to day last, all both inclusive of all of my distributions, or the sale or refi, whatever it may be. On average, my money went from 100,000 to, let's say, 200,000, divided by, X number of years. On average, that's the rate of growth, how my money grown. So I kind of like looking at that as just kind of high level, before I dig deep into all of the, what's the waterfall split? What is the population growth in Texas versus, California? What is this, that, and the third? That just my average annual return projected, what that would be. So those are some of kind of the high level things that I look at to see, those are the metrics that I look at to be like, okay, do we have a little cash to keep us fed throughout the time? On average equity multiple, okay, over 5 years versus 10 years, what that looks like. And then just on average, each year, my money is expected to grow at what rate with that average annual return.
I love that answer, especially because you mentioned the all of the above, because they all definitely they all definitely matter. I'm just gobbling up that answer like a delicious subscribe sandwich, which
Push the button to subscribe. Push the button to subscribe.
yeah, it's subtle, isn't it? Just like the next segment here, it's with the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through all 6 of them once again to make sure that you understand how my guest fits into those deals, and also how deals work in general as far as what's essential, how these all work. And as I'm going through this, you might think to yourself, wow, I really need to get one of those cubes. And the great news is it's absolutely free. You go to dandoesdeals.com, which you can barely read because the curtain's in the way. But if you go to dandoesdeals.com, there's this big conspicuous button. You click on it, goes straight to the PDF. You can download it, print it out, show it to your friends and family, and become more effective at communicating on the subject of commercial real estate deals in their teams. So the first role I want to talk about, though, is the most visible person of the bunch. It's the repositioner role. The repositioner is the deal finder, but more importantly, they're also a bit of the brains as far as they're finding the upside in the deal. So the first thing they need to be able to do is they got to do the arithmetic. They got to do the math, figure out, first of all, is this property even actually making the amount of money that the seller/broker is claiming it is? Because right? Anyway, so repositioners are the most public-facing people. So you're probably, if you're talking to a real estate person, you're probably talking to a repositioner. And the most peculiar part of repositioners and their jobs is they always have to have a big circle of financiers. That is lenders, bankers, all that sort of stuff, passive investors. A financier is someone who deals with the owners, the capital, and the paperwork, and that's it. They are not involved in any operations or any of those types of major decisions. And the reason why repositioners need to know lots and lots of financiers and investors is because if they can secure a more advantageous loan, in other words, cheaper money, that goes straight to the profitability of the property. So that's why they're always engaging with more people who are financiers. But the next more conventional spot that a repositioner will find upside is they'll take a look at the operations and say, hey, what's happening with all those Benjamins going down the toilet? Now, of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and all that sort of stuff. Me personally, my GP experience, the reason why I was able to get on these teams, it's a mixture of my tech acumen, so any sort of automation or outward-facing web applications, social media, whatever, I take care of that. But the bigger part is you have to understand that vacancy is the enemy when it comes to real estate deals. So even if you're like me and targeting 100 unit or more properties, basically you have to have that third party property manager involved. The fact is, if they can't fill the units, somebody on the GP team needs some serious marketing chops to get those units filled, and that's where I throw my hat into the ring. But there's only so much you can do as far as operations go. It's a competitive industry, so don't expect that you're going to be able to cut expenses too much. But the next place that a repositioner will look to find that upside is they'll get a contractor team involved to renovate the place, do a value add, make it nicer. The idea being that the future residents would be more than happy to pay more in rent than the previous ones because it's a nicer place. Now, of course, if only things were that simple. The fact is you can spend endless amount of money on upgrades and renovations. You can go ahead and gold plate the toilets, but I don't think you're going to get a decent return on investment. And if you're like me, see, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because that won't be me. I'd still be stuck at an airport in an hour or two. So I need to have somebody I can rely on to go check on the property, make sure that the contractors are keeping to schedule, they're not dragging their feet, they're not using subpar materials and all that. And they're also not sloughing the photographs and misrepresenting the property as far as the property management phone calls and meetings end up going. So they're the person you rely on for that. Now, for the sixth and final role in a commercial real estate deal, I like to use a little bit of a hypothetical. Let's say maybe you're a physician or a surgeon or an attorney or an engineer, something like that, and you're thinking to yourself, well, I have a couple rentals of my own, and I'd like to get into apartment buildings or bigger commercial properties or something like that. And you're saying to yourself, well, hey, I know how this works. I get my down payment and I borrow the rest. And you think, hey, you know, that apartment complex that's 350 units down the street, I bet you if I turn around to my colleagues at work and say, you know, hey, let's all throw in like 100K each and we'll take over that building over there. So full of confidence, you turn around to the bank and you say, I want to buy that massive building over there that's worth tens of millions of dollars. You don't happen to have, say, tens of millions of dollars that you want to lend me, do you? And the one spot where they're going to pump the brakes a little bit, these financiers, if you are involved in some sort of coaching or mentorship or something like that in real estate, I really encourage you to listen carefully to this next part. The bank is going to say, who's your sponsor? Who's your KP? If you're going to be eligible for a commercial loan, they are in the business of making sure that they don't lose capital. So they can't lend you a bunch of money just for you to have no idea what you're doing, and then you run the property into the ground and the depositor cash is all gone. So one way that they protect it is they say they will not consider people to be eligible for the loan unless somebody on the team already owns a similar asset. In other words, unless you have somebody in the fold who already has a 350 unit apartment complex, there's going to be no 350 unit apartment complex in your future with loaned money. On top of that, you need a certain amount of liquidity to prove that you can actually run the business. And on top of that, you have to put up collateral. In other words, have a balance sheet among the GP team of at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So Terra, you already mentioned that you're focusing on the passive side, which makes you more of a financier. Are there other roles that you anticipate having in your next commercial real estate deal?
So no, so I am not looking to be an operator or a sponsor or a contractor or, I mean, maybe hard hats look good on me, but whatever. No, I am through and through a limited partner, an LP. And so I like to hitch my wagon onto those that are experts in contracting, experts in operating, experts in sponsoring, experts in property management, asset management, etc. Because I don't need to know everything about everything. I know what I know and I don't know what I don't know. And what I do know is I like earning passive income. I like having what I call the dings come onto my inbox. You've just been wired ding for this investment. You've just been wired ding X amount of money for that investment. And so I trust that whoever I'm partnering with, that's a part of my job on the front end is to vet them that like the bank is saying that you've done this before, you know what you're doing, you understand how to run a 350 unit multifamily, you understand how to run a hotel asset, you understand how to run a fund of industrial properties. And so I don't need to know how we negotiate a 20-year, triple net lease contract. I understand what it is. I understand the general makeup of it all, but how we build in rent escalations and how we, handle the insurance costs, whether you're paying it, I'm paying it, but somebody's got to pay for it, et cetera. All of those different nuances and how we run, let's say, an industrial piece of real estate or whatnot. I don't need to know the through and through. When you got an insurance question, I'm your girl. When you got a question on how do we operate this multifamily, that's a different ballpark. And so I like to stay in my zone of genius and my zone of excellence. And with that, my job on the front end is to vet them that they understand and get it with all certainty, as much as I can possibly be, quote unquote, certain in something. Just have the best possible verification and due diligence or whatever you want to call it, that they know through and through what they're doing on this deal. And even, with the best of intentions, we can still make bad investments. We can still make bad deals. So, but that is on that LP, that passive side, to where I don't need to know everything about everything. I just have a good framework on how car washes operate, how, multifamily operates, but through and through, far and wide, deep into the space on how to properly purchase, manage, execute, and exit that deal. And so that's what I want. I want to be on your team. And so I want to tie it with you. And I trust that you're going to be a good steward of my capital and executing that business plan.
I love that answer. So let's talk about the properties themselves, the buy box. When real estate people are asking each other, hey, so what are you looking for? What's your ideal property? What's your buy box? We're really asking about three main things. The first one's location. Where is it? Which state, which county, possibly even which neighborhood. Before you call it ideal, that's absolutely going to matter. Now, the second one is size. We're talking more often with my guests with multifamily, so we're talking apartment complexes. And the way you define size in an apartment complex is by the number of apartment units, which is known as the unit count. The reason why it's relevant is because the type of team that's going to be taking over 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 150, 350 unit apartment complexes. So that's why the size is relevant. Now, of course, there's other types of commercial real estate that don't go off a unit count, like retail or warehousing. They'll go often off of square footage or even acreage, but the size concern still matters. But the third one is commonly called class, but I don't like that term because it makes it sound like it's only one thing when it's actually two. So I like to call it desirability. Those two things are, there's the condition and then there's the area. If you're talking about condition, it's how old is the building, how beat up is the building, how recently renovated is the building, and then of course what sort of luxuries and amenities are included when somebody chooses to stay there or lease or whatever they're doing. Now, when you're talking about the area, the crime rate is always going to matter wherever you're talking. So that's going to matter. But if you're talking residential like multifamily, another quirk of that is the school districts where the property is located is going to be highly relevant. But then the last part of the area is the old broker trope of saying location, location, location. I don't like that saying because I think what they really mean is traffic, traffic, traffic. If a gazillion people pass by that property every single day, it's going to have some built-in desirability that you just can't replicate otherwise. And both the condition and the area are ranked the same way as in grade school, where you have A plus at the top and then A and then A minus and then B plus and then so on. So Tara, as far as your investments goes, where's the sweet spot?
I'd say the sweet spot is in B. Is in B for sure. And the reason why I say B, if we're speaking, on multifamily, is because Bs want to be As, and As will accept a B, even though everyone desires to be in luxury and to be an A. So I think you have a wider a wider pool, or what's the word, like a tenant pool, resident pool of folks in B. And then also because people in C's want to be up to B's, and they maybe with a side hustle or a promotion, they can get into the B class communities where it's a larger leap for people in C and D's to get to an A, and you really fell in hard times if you're an A and you fall into a C or a D. So I think A's will accept B's. B's desire to be A's. C's desire to be B's. So I think the sweet spot is that B class where crimes are typically not as bad in a B class community. It's probably a bigger pool of residents that fit into the B's. And I think you got a kind of a taste of a somewhat good life, and so you're desiring to keep pushing to get into that A, and it is possible when you're at that B's. It's kind of the age-old phrase. I think I've heard someone, I forget what famous person, Buffett or someone said, or maybe it was Scott Galloway, that said something about like once you, or no, it was Buffett, your first million, or Munger, I think it was Munger, sorry, Charlie Munger, I think your first million is the hardest to make. But then after that, the next million, up to 5 million, is a lot easier. But it's getting to that first milestone, to get to that first million. That's probably the hardest. But once you get there, that making it to million 2, million 3, you kind of maybe what you're doing, or you kind of got the framework down. It's a lot easier to get from 1 million to 5 million than it is to get from 0 to 1 million. And so I say that where if you're in the B's, you're almost there. You can cross over into that A's. And if you're an A, if you fall on hard times, at least you have the skill set and probably the tools and knowledge to get back into the A. So that was a long-winded answer to say B's.
Right, exactly. And then, of course, there's your network and social circle when that's the case. But as far as states go, do you have particular states or cities or neighborhoods that you prefer, or are you just going to let the numbers speak for it?
So I do prefer kind of the landlord-friendly states. So if at all possible, so the blue states really, I'm sorry, not the blue states, but the red states really, like the Texases, the Floridas of the world, even the Arizonas. Those are more landlord-friendly as far as with their laws, their tenant laws and things like that. And again, it's kind of like Sunbelt states, so it's warmer. People are moving south, in Florida and Arizona and Texas, and so I think those are probably the states that are top priority priority that I lean into, but I do have an investment in California, you know, and in a multifamily there and some other states. I mean, so yeah, primarily I'd say that kind of the, you know, the Sun Belt or even kind of that Midwest. Ohio is a lot of talk in a booming market, even Alabama as well. So, but yeah, and probably stay away from a lot of the kind of the blue states as far as, you know, just because they tend to be, not, this is a sweeping statement, but they tend to be, you know, more resident friendly. But when you're on, you know, the ownership side of the coin, you want it to be more friendly to your interests.
Right, right, right. And I don't want to get in too far in the weeds, but that's one of my major ideas that I want to get across is I think that when they say landlord friendly versus tenant friendly, I think that they're already framing the argument incorrectly. Because when you say tenant friendly, what's really going on is the government saying, sure, you can buy this apartment complex, but you can't really own it. It's ours. You're just kind of like riding that mechanical bull for a limited amount of time until, you know, like the next guy or whatever. And I think that that's a more fair representation of the situation here, right? You know, you don't want a situation where you're buying something as an investment and then you're told it's like, okay, you can't raise your rents this year, even though every single one of your other expenses is going up. But, you know, it is what it is. But that's a people... Yeah, go ahead.
I always say it also depends what side of the coin you're sitting on too. So if you have owned nothing and you're through and through a renter, and you know you want it to be in those states where everything is favorable to you and rent caps, and you know you can't do this and they can't do that, and you know and you have a lot of leeway. But if you're on the other side of the coin, if you are on the ownership side, if you are in the operator side, then you want through and through to be there, and that's always an you know, to be on favorable to an equity ownership side, and so that's always kind of the tug of war and the pull, getting into just capitalism. Like it has to rest on a bed of empathy for both sides, to where the government can't just tell you can't rate cap. Well, then you better put a rate cap on insurance costs, and you better put a rate cap on property taxes, and you better put a rate cap on a lot of other things, because as those expenses go up, to stay afloat, we have to do those other things. But on the flip side of that, oh my gosh, I've never had a claim. I'm an insurance person, never had a claim, but yet my rates are going up. So who's going to cap that, you know, on the buyer side when I'm paying for these premiums and whatnot? So as a tenant, the same thing, like you want some type of control to where it's just not the Wild West and anything goes, you know, so you can be able to operate your business if you're in an industrial space. So you can be able to stay stationary, not having the moving expense if you're in a multifamily. So I think there's tug of war on both sides. And so just depending on what argument you're making or what deal you're looking at, which side of the coin that you're on, your argument will change, and my argument will change depending on what side of the coin that I'm on.
I agree, and that's how inflation works. The only thing in the world that ever gets cheaper, it seems, is TVs. But you know.
Yeah.
But let's move on to people. People are definitely my favorite part of the real estate industry. Maybe that's because I came from tech, where people are famously antisocial. But I might also be because commercial real estate is multifaceted. You got all these different roles. Nobody's going to be all six for any meaningful amount of time. They're going to pick a role and they're going to really turn it into their expertise. But we'll still be eager to help build new teams, make referrals, all that kind of stuff. But since everybody has their own skill set or expertise, the fact is we're going to be more useful to some people more than others. Now, of course, everybody in real estate is in the industry of deploying capital. So that means everybody is interested in meeting more investors. And so if you are an investor, be sure to reach out to me or Terra, and we can discuss what your needs are. But for me personally, with my tech background and my marketing background, my social media presence and all that kind of stuff, the people that I tend to be looking for the most are the sponsors and KPs, just because they already have a business foundation put together. So a guy like me can make a disproportionately large difference. When you're first starting off in real estate, you need grunts who can work 80 to 120 hours a week. That's just simply not how I'm at my most effective. But Terra, as a passive investor, I imagine it's also the sponsors and KPs, but also operators that you want to tend to meet the most. But who's out there in the audience that you're most eager to speak to?
So twofold. So yes, always sponsors and operators for deal flow. And you know, truth be told, I don't think there's any shortage of that. out there, at least not in my inbox. But for me, it is other investors, other busy professionals like myself that love their day jobs. They're doctors, attorneys, accountants, active flippers, home flippers, or whatnot, that enjoy what they do on the active side of their income, but want to find ways to hire Benjamin Franklin, George Washington, and all those other guys and putting them to work with no days off. And that's putting their money to work, putting their dollars to work. And so those people that are looking to at smaller amounts, as opposed to writing, or wiring 50 or 100K for each deal, that want to do it at smaller amounts, say anywhere from $5, $10, $15,000 at a time, where you can pool that money with other like-minded investors to be able to invest in that operator's deal. So those are the folks that I'm looking to connect with, are those people that have some discretionary income, that are busy people, busy professionals in their daily lives, but are looking for ways to put their money to work in a strong asset class like real estate. Join the Power Pool Fund, join our investment club, and start to vet deals alongside us as we're talking to different operators and sponsors. Bring your own thoughts and opinions to the conversation, and bring your funds together to where, maybe 5,000-10,000 isn't going to keep you up at night. I guarantee you 100,000 plus will keep you up at night, if you're investing in one deal with those kinds of funds. So, get into 10 deals. If you got 100K to invest, do 10 deals at 10K a pop. And invest in get to spread and diversify across different asset classes, different sponsors, different markets, by doing that with an investment club like Power Pool Fund.
I love it. And so I'm sure people in the audience are sitting there thinking, I got to know how to reach out. And I'll sandbag that for a second and talk about myself. Fortunately, I got this really distinct last name, makes me super simple to find online. LinkedIn is the social media platform where I spend most of my time. So that's definitely the best way to reach out. I did already mention that the other episodes of Chance Encounters are shown on dandoesdeals.com, along with the download for the cube. The QR code you see right here, if you scan that goes to the author page on Amazon that I have for some of the different publications I put out on different business related skill building, or of course the silly hat for marketing reasons there. The real estate is a scam.com. Those are the best ways to reach out and get involved with me. But Terra, social media, you mentioned that group there. What are the best ways to reach out?
Yeah, so on social media, Facebook, Instagram, YouTube, all at powerpoolfund.com, spelled just how it sounds, powerpoolfund.com, are on those websites, are on those social media platforms, Facebook, Instagram, and YouTube. Powerpoolfund.com is the website, and there's a link on there where you can click schedule a call with me, or simple shoot me an email. Shoot me an email at info@powerpoolfund.com. That's info @powerpoolfund.com. And let's schedule a call, and let's chat, let's talk. Like I said, we do group investing. So it's not, I put my money in every single deal that we invest in. So reach out, let's talk strategy, and let's pool money together so we can attack a bunch of different deals and not have to, wire these big check sizes and do, one deal a year, where we can do multiple deals every year by just doing smaller amounts and pooling it together to invest in third-party deals or in operators deals. But info@powerpoolfund.com, powerpoolfund.com is the website, and then on all socials at powerpoolfund.
I love it. And that only leaves the last part, which is actually not for you, Terra, it's for you in the audience. It's my public service announcement. If you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's still down there. If you got any youngsters around, they're going to see that you haven't subscribed. They're going to judge you. Okay, full disclosure, I want a bunch of people to hit the button so that those deadbeats at YouTube start to pay for these videos instead of me. I think that'd be fantastic. The trade-off for you, just to be clear, is my videos may show up on your list of suggestions. You can go ahead and ignore those suggestions. I just appreciate the fact that you spent this time with me. Just like Terra, I appreciate you joining me. This has been awesome.
Yeah, awesome. Thanks for having me, Dan.
My pleasure. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a Chance Encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute Chance Encounter format It checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.